We're snorting cap rates and shooting up cash flow here at Deal Junkies. Welcome back to Deal Junkies. I'm Gabe Johansson, back in the SMI studio with Mike Nuss, Trevor Howard, and we've got Jordan Brown back in the studio. Thanks for joining us, Jordan.
Thanks for having me.
We are in a mad rush to get to the SRE meetup tonight because we're going to record a live episode of Deal Junkies. But before we do that, Trevor wants to make Avery mad and record a quick podcast before we go record another podcast.
We're going to be fashionably.
It's not going to be quick. It's going to be an hour long. This is a big deal. All right. So we're back to talk deals. Let's talk about deals with Jordan. We want to hear about your deals. So I want to talk about a specific deal that we're trying to do right now with Jordan. It would be best if we had Mark here because this is a piece of land that Mark has that's how big? This might be part of the problem. Yeah. We don't even know what it is. So Mark owns
between 1 and 1 million feet.
Yeah. This is in Spokane. It's
this is Mark's project. He's been trying to get off the ground for like 3 years.
Yep. He has this free and clear piece of land, and so we can take it to the bank and leverage it in phases. And we can put how many square feet of storage on this thing?
65,000.
65,000, which is a lot.
Have you looked at the Spokane market yet?
So it's in Cheney, which is
Cheney?
Yeah.
What's a Cheney?
Cheney? I don't know.
Is that
south of Spokane?
It's near Spokane.
Yeah, we're Eastern Washington University.
What happens in Cheney?
Not as much as in Spokane.
Is it pronounced Cheney or is it Cheney?
I'm not sure, to be honest.
So we don't even know how to say the name of this place, and we want to build some storage there?
It sounds tertiary of the tertiary.
No, I mean, it's right on the edge of Spokane, right?
No, it's like 30 minutes south.
Oh, really? I don't even know. Okay, my bad. I don't know where it's on the map.
So that deal is a little unique. I mean, last podcast, we talked about how storage is from a micro standpoint. One Spokane southern side could be oversupplied, northern side could be completely undersupplied. So smaller markets, you definitely have to be a lot more careful going into. It's very easy to overbuild. From a first glance at that market, it looks to be overbuilt and population's lower. However, you do have the college, and when I started shopping around and calling facilities, I realized the big facility right across the street, I called them 15 times over 3 weeks. Never heard back. Emailed them. It took them like a month to email me back. And they're like, yeah, we're full. So that's a good sign. The other facility in town was 100% full. And then they have one big operator that their rates are, top of market, double what the other facilities are charging. So it kind of got me a little more intrigued at that point. Now the big question is, can we go in and develop it at a price that makes sense?
What's the population on it in Cheney?
Like the 8 on like a 5 mile radius is kind of where I look.
Yeah.
You're sitting at like 15,000 people.
Okay, so it's just big enough on the smaller side of where you would do it.
And how many feet of storage do they have for your 15,000 people? Was it
like 170,000?
So it's over $10 or 10 feet.
Yeah,
but not that high over.
But not much
That's like,
over.
what is that, 12?
I could be wrong. On a 5 mile, it was at like 15 square feet per capita, which is
15. So you're a little on the high side.
Right. Yeah.
But you've got a full, they're under rented across the street, which is why they're full and not calling you back.
Yep.
But you got somebody else renting them for double, not far away.
Yeah. And anything on the 10 by 10s, 10 by 15s, 10 by 20s, your larger units are completely full.
How do you feel about that with brand new storage? Like, is there a difference? And would you build a nicer complex than the one that's cheap? Like, you're not going to be able to compete on price with the ones that are so cheap across the street, right?
No, I think ultimately...
But they're full.
Right. Ultimately, people want to put their stuff somewhere that they feel it's safe and secure. And if you can come in and, build a better product where people feel like they're getting more value out of it.
Why don't we try to buy that one that's under rented? That'd be a better thing than building.
Absolutely. If they answered their phones.
It sounds like a disengaged owner that might just want to cash out.
It could be. That's why I'm sending them some mailers.
Well, so to me, this deal is confusing because we have like the rents make sense. The market makes sense from a high level, like due diligence before diving too deep into it. we have a free and clear piece of land with a willing seller who will contribute the land in the partnership, which usually works.
Have you ever heard the saying, just because you can doesn't mean you should?
Yeah. Yeah, dude.
Wise individual.
But, and then it's like the cost to build is like, Mark has an appraisal on it for like $11 million when it's done. And do you know the cost to build again?
Yeah, cost to build's $5.8 million. My valuation's nowhere near that.
Yeah, so appraisers are liars, just like bankers.
So it's not going to be worth 11.
Former appraiser.
Appraisers are weathermen.
Yeah. So that's
they're always wrong. They get paid to be wrong.
Yeah.
But even with that gap, if we can go build a cash flowing asset with no extra money and create some spread that's risk related, you don't want to go under.
You talked about phases. How easy is it to build something like this in phases so you don't just completely overbuild?
Yeah, so why I wanted to do it in phases, I like this play because you have this free and clear piece of land worth like 800 to 1.2, so it doesn't get the whole project done based on like a 75% loan to cost, but it can get phase 1 done, and ideally you create an equity pop. And now you re-leverage it to build phase 2, and then you're not overbuilding the market, so you can sit on it for however long you want. So we can build 20,000 square feet at a time, which may be more manageable.
How's your financing work for that? You're going to work 2 different loans altogether for phase 1 and 2, or would you have a phased out?
I would have to see.
Loan?
I mean, ideally, you can work with one lender and they re-up the loan essentially, so you don't have to go through multiple processes. But you could do it on multiple loans if you can create the equity pop. But I think the problem we're running into is just you're not going to create the equity pop, correct?
Well, it's more on the build cost side. And I mean, even if we do phase 1, when I looked at that again, I mean, fully stabilized phase 1 with that upfront development cost, I mean, you're not even break even from a cash flow standpoint.
Yeah. So are the rents just not high enough in that market? Is Mark really bad at building storage?
I think the a lot of the site work from what I talked to Mark is you have higher site work with that location, because then coming in and actually building the storage side is pretty low on a price per square foot.
Mm-hmm. What's the site work? You got to move a lot of dirt or get some. You don't really need a lot of utilities and stuff. You just got to.
Yeah, I told Mark, I'm like, hey, we need to have that come in at $800,000 lower.
I mean, you're just pushing dirt. What are you doing? You don't bring in sewer drains and water and all the stuff.
Mark wanted to make a really big fee on this one.
Oh.
Yeah.
I don't like this deal.
So like conceptually high level, it should work. So I feel like, I mean, maybe we're not, but like just think about it from a high level. It's like you have all the pieces that typically make a deal work. But for some reason, we're not connecting the dots, and I can't dive into it well enough.
Has Mark tried to sell this land?
I think it was listed.
Yeah, but Mark likes to sell stuff for triple of what it's actually worth.
Okay, so you're saying it was listed for too much?
Probably.
What was it listed for?
Probably $3 million, and it's worth $1 million. That's what he does.
Are you saying it's not worth that? So I don't know. I mean, I would want to do more research on finding out if he had the land listed and nobody wanted it. That would tell you one thing with the land, because even if you have an appraisal for $800,000 to $1.2 million, you said for the dirt, doesn't necessarily mean the dirt's actually worth that. You might get a loan off of that.
Correct.
Doesn't mean you could sell that dirt right now.
Yeah, so the problem I was running into is we have too many cooks in the kitchen. I'm running around talking to Jordan, then I'm going back to Mark, and then they're all giving me all this info.
You can't, I mean, so Mark is our trusted partner, but in a deal like this, you can't trust him because he's emotionally tied to it because it's his piece. And he's had the dream to build it for many years, and it just, for whatever reason, which I'd love to know, why it hasn't come out of the ground yet.
Well, so far it's because you're going to go build a $5.8 million project that's worth $5.2 million.
And I have it, fully built out and stabilized. I think it's worth 7.2. So you have the equity side, but then fully stabilized. I mean, your DSCR is like 1.15.
Yeah.
So
do you think that's worth doing if you can fully lever it, put no more money in, create $2 million of equity, but you have a low DSCR?
I mean, I would do it in phases, and I would want to see the property cash flow.
Yeah. I mean, 1.15. I mean, your cash flow.
That's fully stabilized the whole thing. If we go phase 1, or with the original building out retail space, some storage, and some RV parking, covered RV parking. I mean, your DSCR is like 0.6.
Oh, I don't like that.
You're covering a big bleed, and
to
we
don't want to do that.
That doesn't make sense.
No.
I think Mark should sell this land.
Okay. I think we should figure out why it doesn't work, because you got to go sell it to someone that has to make it
Is
work.
there a better use?
Can you tell us? You're the most qualified in the room to tell us land use. Can you tell us?
Well, I mean, so you can legally build it, you can physically build it, but it is not economically feasible. So that's why it's not being built, is it's just not economically feasible.
Yeah.
So then you start looking at, well, are there other uses that can be done?
But it's crazy, because as you start looking at other storage deals, this stuff is so cheap to build and it rents for so much.
Doesn't matter. It doesn't matter.
I think there's just some, and I haven't been able to figure out what the disconnect is. So I think we just all need to hop on a call probably and really dive into it. But I was hoping we'd figure it out.
I think we should buy the one across the street, and then if that does really well, then we add to it later.
All right.
Agreed.
Oh, yeah. Jordan's
cool. Solve the problem.
Agreed.
Yeah.
Yeah. No. Ultimately, and that's having the conversation with Mark on a lot of those upfront development numbers, and saying, okay, why is site work $800,000?
Mm-hmm. If he were here, he would tell us why we should do it, but he also hasn't done it yet, so there's a reason.
Yeah. Okay. Well, I thought
we still love you. We still love you, Mark. But this episode's over.
This is what Trevor was all hot and heavy for. Was
I think
bad deal that he doesn't know anything about.
I know a little bit. We went through the underwriting. I think it would be interesting. Have you fully syndicated any of your other deals?
Just one, not like to an exit, but I syndicated one deal.
The second deal you bought?
Yeah.
Have you syndicated another deal outside of that, or been part of the syndication?
I've raised money for other syndications.
Okay. Yeah. Do you want to talk about that since you're doing it right now, just because you'll have genuine questions?
Sure.
All right. Can you start asking
Mike's such a genuine guy.
Tell us about this deal, and let's deep dive it, because Mike has been he's doing a 48, 46, 57 something unit that he's going through the syndication and the loan process on right now. So I love talking to Mike about it, because it's the first time he's asked me a question.
But I didn't come prepared to actually ask questions today.
Well, let's start diving into the deal. Tell us about the deals, how you've been going through the raises, and because what point are you at in your deal, Mike? You're needing to get loan and capital still. You're at the early stages of you just put it under contract.
Yeah, we're done with our due diligence, and now we need to start moving to closing. So it's time to hire the attorney, get the docs created, get the syndication done and funded.
Yeah.
Talk to a handful of people that are interested, but now it's to firm up commitments and actually get capital.
Did you build a presentation, like an offering memorandum?
Yeah, we got a pro forma, and so we've got a rough draft of a pitch deck. So we need to finish the pitch deck. So
yeah, let's talk about raising, because you've been doing that a lot, and I think I wish
you said you're raising for other groups, or
no? So I did. Well, yeah, for a year, I helped raise funds for syndications that one of my business partners was doing.
And you can do that because of your licensing that you got through your securities licensing?
No, that's why I quit that.
Because you're not supposed to do it?
I was not allowed to do it. Yeah, if you have your Series 7 or 66,
you're not supposed to.
Yeah, that's selling away, and it's a big no-no. So
they wanted to sell their own firm securities, right?
Yeah, you can't. I mean, obviously a syndication, you're creating a separate security. Mm-hmm. So if it's not affiliated with the firm or their product, you can't do that.
It's called selling away.
Yeah.
But is that a licensing issue, or is that a firm issue?
Probably firm.
It's firm, and then I also obviously
you're licensed to sell securities, so can't you sell a security?
Yeah,
but they don't get to make money on the real estate.
There's a conflict of interest. So me being with a license to sell a security, but then if I'm creating another security in this real estate,
it competes with the ones that you're selling.
Well, yeah, but then if you're my client and I say, hey Gabe, I have this great opportunity, come put $500,000 in it,
or let's move some of your money around and come over to mine. Yeah,
that's where the conflict of interest is, obviously. So.
So not anybody can just go out and raise money either, though. I mean, that's a problem.
Yeah, because you're part of the GP on those deals.
Yeah.
So as the GP, you can go out and raise money.
Correct. You can't third party go raise unless you have those security.
Yeah,
licenses.
we have one partner, Logan and I do, that has a securities license, and we've done a couple of deals, and he had to bow out and not be part of them because of his licensing.
Yeah, and ultimately that's why when I was a part of my first deal. And they said, you can't do that. I'm like, okay, I'm not putting no money in this deal. I'm going to have $1 million of, additional ownership in this asset. That's going to get me a whole lot farther than my commission-based, financial advising position.
You could see where your bread was going to be buttered.
Yeah. Yeah.
So when you're raising money, are you raising from people you know or like people you don't know? How are you finding these people? What conversations are you having?
So, I mean, now I guess with raising I do now is typically with people. I mean, people I do know. But when I was doing it for them, a couple of the projects, we went through other marketing agencies that brought us lists of accredited investors. They would blast out and market whatever offering we had on their platform and website, and then people would fill out their survey form that they're accredited and if they're interested in the opportunity, and then I would get that list and then I would basically cold call them.
Were you closing those people, or was it really hard because they didn't know you?
It was tough. I mean, obviously your first conversation is you're explaining who you are, your track record, building rapport as you as an owner and operator, and this is taking obviously multiple calls to build that trust. But yeah, I mean it was tough, but we were successful in raising funds.
So you were able to actually close those people from cold to
I mean, it was still. I mean, I think we had on one of the raises we had a list of that came in with 700 people that were cold calling, and we were able to raise from 25, 30 people.
How much?
That was on 2 deals, so. One we needed was like $900,000 for a storage facility. The other one was $1.8 million for another property.
So 2.7. Yeah. So you called 700 people to get 30 people to give you 2.7.
Yeah, rough numbers.
So $100,000 a person.
Yeah.
Have you raised big chunks from like individuals too, or has it been all small chunks mostly?
Well, mostly small chunks, but right now I'm doing well. Originally, I was planned to do a syndication on a hotel out on the coast. I was talking to Mike about.
Can we talk about that deal?
Yeah.
You don't want to give that one away.
Yeah, I don't want to give that one away. But
who knows what state this coastline is in? We don't know where it's at.
One of the West Coast states
or East Coast.
Oh,
it's somewhere where North Coast. It's a North Coast state.
Yeah, this deal. I mean, originally, it's a $3.5 million raise, and for me to go out and raise that much, obviously that I need to be fully focused on that, especially if I'm getting, $75,000 to $150,000 per limited partner. But with someone coming in with a larger chunk, I had a conversation with someone last week. I have a follow-up call with him on Friday. He's needing to do a 1031 exchange, and he wants to bring $2.5 to $3 million to the deal.
Nice.
So then at that point, obviously, just to make sure the economics are right, I'm fine with coming in as doing more of a joint venture. If someone's obviously bringing,
it's easy for you. Yeah. It's easier.
makes it a lot more simple.
Do you have this deal under contract now?
It's not under contract, but I've been going back and forth with the owner for 2 years.
Yeah. Do you think you're close on terms then with him, or like? Because you would want to put it in their contract, right, and get this to start raising for it.
Yeah, definitely. I'm really close on terms, but originally the plan was I was going to sell one of my storage facilities and then 1031 into it, and then with other there's other factors that decided I wasn't going to do that. So then when I went down the raise side, I was like, I've already talked to this guy for a while. I didn't want to really waste more of his time if I felt like I couldn't fully commit to it. So I said, hey, realistically, when do you want to sell this property? He said, okay, next spring, 2026. I'm like, okay, like if that's when you're going to go to market, then I'll go find someone with some money.
What are you negotiate? Oh, that's the sell the property you want to buy.
Yeah.
And then you got to time that guy's 1031 though.
Yeah. And the seller's willing to wait. So we'll get under contract contingent on 1031.
And what are you just negotiating price? Are you doing a seller carry on this, or what are you?
Both. So price and terms, and he'll carry for 5 years.
Okay. And what are you buying it for if you're putting 3.5 down?
Originally it was 8.5, but that was based on revenue kind of last year. So this spring was a little bit slower. It's still fine, but I think we'll come in right at like $8 million, 5% interest only.
Okay. And then are you worried about going into a different asset class than storage that you haven't managed before?
Yeah. So obviously going from storage where it's a lot simpler in terms of operations to something like hospitality, I don't have much of an interest in, but it's all about making connections and building trust with people. Obviously you guys coming into storage and, finding me as an operator. So I did the same thing. I have a friend who owns multiple hotels, and I said, hey, come in, help me raise the money. You operate it. We'll split equity.
So what's the play on it? Is it value add that you can do, or you're just emotionally attached to this property? Because I know the thing is, Mike would be emotionally attached to this thing, dude. He loved the deal when you told him about it, huh?
It's a little bit of both. I mean, I am emotionally attached, but
don't buy it. Don't buy it.
Right, but at the same time, like obviously, like I'm not going to buy it if it doesn't.
Yeah. He's being fiscally sound.
Yeah.
Yeah, I mean, I've told you before, like I'm naturally really overly conservative, and that's limited a lot of my growth. But at the same time, like I want to protect what I have.
Why would you go into a whole new asset type when you've already learned one? Do you want to learn other asset types, or do you just see there's money to be made?
I see the upside. I've been staying at this. It's a boutique hotel for like the last decade. It's 27 rooms. All of them are oceanfront. With the beach access.
Don't give away too much.
Yeah, but I'll say, a hotel that's across the street with no oceanfront or view, they charge $100 more a night per room. And so there's definitely a value add play.
What kind of cap rate are you buying this at? Because
this is at a 9 cap.
That sounds cool to me. Then, dude, you're getting 5% debt with a 9 cap.
Hospitality's it's not a static investment. I mean, you're really buying a business with a building.
But that stuff typically is trading like at a lower cap rate than that still, right? Like 7.5 or
Hospitality, I mean, like 8's kind of your premium.
Okay.
I mean, it depends on the market, obviously, but hospitality is going to trade a whole lot.
So if you could buy anything for an 8 cap and you're buying this for 9, you must have an equity plan. I mean, you think there's an equity pop here just by improving the operations.
Yeah.
Creating better revenue.
Yeah, and then diving into just their operating expenses. They're paying quite a bit for their main manager and assistant manager. So
is it like 25%, 30%? Oh, they have on-site.
On-site, yeah.
How much? And you're going to do your buddy virtual?
Well, it's going to be like a hybrid.
Okay.
So we'll have manager there for check-in and check-out hours, but then kind of go do a hybrid Airbnb remote check-in.
Do you think a project like that, because it's more of a sexy play, is easier to raise on and people get more excited about it?
When I've raised for hospitality in the past, no. It's a whole lot easier to raise for self-storage because it's predictable cash flow versus hospitality being different.
What do you think about this project, Mike? You want to invest in it?
Yeah.
I don't like this one either.
I think hospitality trades more like on a per key basis rather than a cap rate basis because it is a business model and it's how much revenue can you get out of each key. That being said, if you've got an operator that knows that he can do a value add on the operation side and you can get a 9% yield and 5% debt, then it's a good spread.
Are you going to IO on the debt, and how long?
IO for 5 years.
Okay. And then you just refi it. And then typically hospitality is like a 25-year AM, higher DSCR or something?
Yeah. Typically they want to see a DSCR of like 1.5.
Ooh.
Yeah. So no, definitely. I mean, I've been going down this for like the last 2 years. Obviously being a storage operator, that's my focus, but I've been staying here for like the last decade. So I'm like, if I can make it make sense, and I'm kind of basing on like the historic numbers that it's done over the last 5 years.
Yeah.
And I'm like, okay, this is where their revenue and expenses are. If I can buy it where it makes sense at that price point with those numbers, then cool. I'm definitely not going to base it on what my pro forma is.
Yeah. So is your partner coming in and coming up with all the operational efficiencies and he sees them all?
Yeah.
What other stuff is he seeing? So it's increased nightly rent.
There's no dynamic pricing at all. So without giving away, other locations, but they just have their summer rates and winter rates, but they're with other things in the area, just not having any dynamic pricing. And then there's no marketing, it's direct booking. So you have to literally call the place to book it.
So it's just an old school owner again.
Yeah, and coming back from my storage side, like trying to find mom and pops with no website and where's the value add, it's similar in that aspect where I see that.
That's the building we're looking at right now has 0 online presence. Like you can't find their units for rent. Like they have vacancies and they're not for rent on the internet anywhere, which is crazy. And it's like a big apartment complex.
Crazy for you because you understand it, but not crazy for someone who's never done that.
I mean, he's a wealthy man, sophisticated. I mean, it's just like
and he got wealthy not having to do that. So he's wealthy. Why change what's working?
He made a lot of money on the building still. Like he did very well.
But those are the exact type of people. Like that's the low hanging fruit.
And I guess that does. So I was thinking about our projects, and when we buy a project and we go maximize every unit, I don't know if that's good actually, because someone coming in and buying a 70s to 2000 product wants to buy it with some value add left. So
you got to leave a little meat on the bone for them.
Yeah, or I don't think you can really exit it very easily because no one wants to buy they just go buy new construction at that point. Like, so I was like, because we've been maxing out all our projects and a lot of them are in terms of refi, it makes sense. But like if we're thinking sell on some of these, I think it makes it way harder to sell actually.
So here's a would you rather. Would you rather buy a 1970s product fully renoed at a 7 cap at $200 a door? Or would you rather buy a brand new product where the rents are 35% low for a 5.5 cap at $200 a door?
For sure that, because you don't have rent control on it, and so you can instantly increase the rent.
So now when you think about it, you go out and do these value add plays. When you take a 70s product and you totally reno it, and you're getting the NOI to compete with new product. When you go to the market, people are going to say exactly what you just said. They're going to say, well, why would I do that when I can go buy new product for the same thing per door? And I don't have to deal with aging
CapEx.
Systems, roofs, plumbing, electrical, HVAC, and everything else.
Yeah.
The numbers make sense. You go, yeah, of course I want to buy this thing at 7.5 cap. But when you look at it, it's the same cost per door to go pick up a distressed brand new property. Why not just buy the new one?
Yeah.
I don't know.
I don't know either.
I know Avery's going to be pissed if we don't leave.
No, dude, we're good on time. She said run it to 6 and then show up 15 minutes late.
She definitely did not say that.
All right. We're going to record. You want to talk about another deal before we go?
We got a couple more minutes. You want to tell us more about our deal, Jordan?
Trevor just likes to push things to the last minute.
All right, we should actually probably wrap it up. I'm going to be in
All right, guys. Well, Jordan, thanks again for being on the show. If people want to reach out to you, talk about now storage or hospitality, how can they reach you?
Jordan at storagelife.com.
All right. Thanks for being on the show. Thanks for listening to Deal Junkies. We love you. Please share us, and we'll see you next time.